Most people think losing money in the market is about bad stock picks or timing. But the real culprit? Your own brain. Hidden mental shortcuts, cognitive biases, quietly sabotage your portfolio. We all want to believe we're rational investors. But our brains are wired for survival, not investing. These biases lead to holding losers too long, selling winners too early, or chasing trends at the worst time. The good news, you can spot and outsmart these traps. Today, we'll break down the top 10 cognitive biases costing investors a fortune, and how to fight back. By the end, you'll have a framework for smarter, more rational decisions. Ready to outsmart your own mind? Let's dive in. First up, confirmation bias. The urge to only seek out information that supports what you already believe. Buy a stock, and suddenly you ignore all the bad news, only listening to voices that agree with you. This echo chamber creates false confidence and blinds you to real risks. That's how people ride losing stocks all the way down, convinced they're right and the market is wrong. Next, anchoring bias. Fixating on the first price you see. If a stock drops from $200 to $50, you think it's a bargain, ignoring that the company's value may have collapsed. Anchoring traps you in the past, making you overpay for what's no longer worth it. Always judge investments by current fundamentals, not old highs. Status quo bias keeps you stuck with underperforming assets just because change feels risky. Instead of selling a stagnant stock, you do nothing, afraid to make a wrong move. This inaction leads to a portfolio full of dead money, missing out on better opportunities. Don't let comfort cost you years of growth. Hindsight. Bias tricks you into thinking you knew it all along after a big move. This false confidence makes you believe you can predict the next market swing. Overconfidence leads to risky bets and costly mistakes. Remember, the future is always uncertain, no matter how clear the past looks. Loss aversion means losses hurt twice as much as gains feel good. You hold losers too long, hoping to break even, and sell winners too soon, fearing you'll lose gains. Both moves are driven by fear, not logic. Recognize this bias to make more rational, long-term decisions. The endowment effect makes you overvalue stocks just because you own them. You get attached, ignoring better opportunities. Don't become a collector. Be willing to sell and move your money where it works hardest. Objectivity beats attachment every time. Herd behavior is the urge to follow the crowd, chasing hot stocks or trends out of FOMO. By the time everyone's talking about it, the smart money is already leaving. Following the herd usually means buying high and selling low. True success often means thinking independently. Overconfidence bias strikes after a few wins. You start thinking you can't lose. This leads to bigger risks, sloppy research, and reckless trades. Luck in bull markets can fool you into thinking you're a genius. Stay humble, stick to your process, and don't let success go to your head. Availability bias makes you overreact to recent vivid news. Splashy headlines distort your sense of risk, panic selling in a crash or piling into hype. Don't let dramatic stories override long-term data. Make decisions based on facts, not fear or excitement. The halo effect is when a great CEO or cool brand blinds you to a company's real problems. You fall for the story, not the fundamentals. Don't skip your due diligence just because you like the image. Always check the numbers before you invest. These 10 biases are always lurking, but awareness is your superpower. You can't eliminate them, but you can catch yourself in the act. Use checklists and systems to keep emotions in check. The real edge in investing isn't just picking stocks, it's mastering your own psychology. Build habits that counteract these traps, and you'll outperform most investors. Smarter, calmer decisions lead to long-term wealth. Like, share, and subscribe for more ways to outsmart your brain and grow your money.